Morning, everyone. Welcome to the session. I see there's currently a lot of students that are joining at the moment. So I'm just going to give them, let's say, another 5 minutes just for everyone to be able to log into the session. And then we'll start at 8:35. Hi, morning, everyone. To those of you that maybe were 2 or 3 minutes late, We just waited up until now. So I think everyone that wanted to be here are now logged in. Okay, so this is then the revision for test 2. And I'm sure you're also all studying financial management, so good luck with that. I just quickly want to say, while I'm doing the test, I'm going to share my entire screen, because if I just share the document, then it's very small on your side. Okay, so I'm going to share my entire screen. So if you have questions, you're welcome to still put it in the chat, but then I'm only going to get to that a little bit later, because this Teams is not giving me a notification on the chat like the Blackboard did. Okay, not when I share my entire screen. Okay, so I will refer back to the chat every now and then, but just bear that in mind. So if you really have something to say and you want me to stop now, then I would suggest that you please then unmute your mic and just quickly talk to me and stop me and ask your question or tell me what you think or whatever the case might be. Okay, so in this session, we're then going to do the paper from last year, the 2024 test 2. Okay, so I'm going to share my screen with you. Okay, so you should all now see my screen. Okay, so just remember your test is on learning unit 1, 2, and 3. Obviously, the focus will be learning unit 2 and 3, since they already tested you on learning unit 1. Okay, but learning unit 1 is not entirely now missing in this test. So just bear in mind that they might ask something from learning unit 1. Okay, if they do, it's not going to be a lot of marks. So I would recommend you just quickly run through learning unit 1, not go and study learning unit 1 off by heart. Okay, that's not necessary. Learning unit 1 for this test will not make you pass the test. Okay, so for this test, learning unit 2 and 3 will then definitely be the focus. Okay, so in the 2024 test, you'll see they asked question 1 was learning unit 2 for 30 marks, and then question 2 was learning unit 3 for 30 marks. Okay, so just remember learning unit 2 is now the revenue that we get from contracts with customers. And then also very important to remember there is that you can only recognize revenue once the obligation has been met. Okay, I'm quickly going to repeat that again. So you can only recognize revenue once the obligation has been met. Okay, I'm quickly going to jump to Excel. Just quickly want to just explain this to you a little bit more. In first year and second year, when we've received money, either for a service rendered or for a sale or whatever, then we would say, okay, we debit bank, let's say it was 50,000 Rand, and we then credited sales, which in second year we said revenue is the better word to use, and then we said 50,000. Okay, that was the journal that we did in first and second year. Okay, and now I'm not thinking of cost of sales and inventory and all of that. We're just focusing on the revenue part. Okay, so that's what we did in first and second year. But then in third year, well, basically in second year as well, when you got to revenue from contracts with customers, we've seen that we can actually not do this if the obligation was not met. And what that means is, let's say you go into a contract with a customer and you say to your customer, okay, I'm going to, let's say, give you a machine. Okay, but I don't have the machine yet. I still need to either manufacture the machine or buy the machine or whatever the case is. But then the customer says, okay, but I want to pay you, or I'm paying you. There's the money because we have a contract. And now what you're going to do is you will say bank, because we did receive the money. Let's say it was 2 million Rand. And then because we still have an obligation, Because what happened now is the customer gave us the money, but we didn't give them anything. We still need to get the machine. Okay, whether it's buy the machine or manufacture the machine, that's not as important. The thing is, we don't have the machine. We still owe the customer the machine. And when that's the case, we cannot say we credit revenue because the obligation is not met. So now we say, okay, we've got a contract liability. Okay, because we still now owe that person something. And then we say 2 million. Okay, and this will be on the date that we receive the money. Let's put that there, on date of receipt of money. And now when we deliver, let's say the machine, like in my example, on the day that we deliver the machine, now the obligation is met. Sorry. Now we recognize revenue. Okay, so then what we do, we debit the contract liability because now it's not a liability anymore. And now we can credit revenue because now we say, okay, since the obligation is met, now I can recognize revenue. Yeah, and there's different scenarios that can happen. Sometimes it can be that you have, let's say, a cell phone with a contract. So let's quickly look at that. So if you have a cell phone with a contract, you can recognize revenue on the cell phone probably immediately, okay, because they're going to pay for the cell phone, you're going to give the cell phone. Okay, so that's going to happen in that specific year, in that same year, or then immediately when they do the payment. But then the contract part will be recognized over time. Meaning if you think, let's say you go to Vodacom, you get a cell phone and a 3-year contract. The cell phone, that's immediately, they can recognize that. But the 3-year contract will then be recognized over 3 years. Okay, and that's what the over time means. It's not going to all happen in this 1 year. It's going to be over time. Okay, so this is probably going to be a standalone price. If they give you something like this, a cell phone with a contract, or a machine with a service plan, something like that. Then something else that they can also ask maybe is if you think about layaway, and this is what you know as lay-by. So if you go to PEP, for instance, and you tell them, this is the clothes that I want, but I cannot afford that now, then you can basically pay them off. And then only once you've paid everything, then they will give you the clothes and then they can recognize revenue. Okay, so there's a couple of things that you just have to run through. There's more or less, I think about 7 where there's different ways of recognizing revenue. Okay, so let's first go back to the test. If we have time at the end, then we can quickly see if we can run through the ones that they mostly ask. Okay, so in the 2024 paper, question 1, they tell us that EcoHeat CC specializes in selling eco-friendly heating systems. EcoHeat CC not only sells heating systems, but also offers installation services and maintenance packages to its customers. Installation services are considered a separate performance obligation. Okay, that's important. Okay, you have to read carefully. So they have a heating system, but the installation is a separate performance obligation. Okay, so probably you can't really use the heating system without it being installed. So there's going to be at least to performance obligations. Then when a customer purchases a heating system from EcoHeat CC along with installation service, the contract includes a standard clause allowing cancellation if the installation is not completed. And then they tell you the standalone prices. So if you see anything regarding standalone prices, then you must know that this is the standalone transaction. Okay, where they going to give you every item's price separately, but also give you a price for everything combined. And then you'll have to be able to calculate the revenue. Okay, so then they give us the standalone prices of the goods. So you get the heating system, that's 120,000 Rand. Installation is 15,000. And then the maintenance plan, 7,200. Okay, is there someone that wants to ask a question? Okay, then they tell us that EcoHeat CC concluded the following sales transactions and approached you for assistance in order to correctly account for the transaction. You can assume that the effect of financing is considered to be significant and there's a discount rate of 7% per annum, compounded annually is applicable. Okay, then they give us the transaction 1 and transaction 2. Before we look at that, let's go to the required to see what do we need to look out for. Okay, so it's always important. You can also actually, before you even read the question, go to the required and see what they want you to do. Because then from that, you can, as you read the transaction, already think of, okay, what do I need to see in this transaction to be able to answer my questions? Okay, so 1.1, they ask you journal entries to account for the sale of the heating system to Danbury Limited, that's transaction 1, in the books of EcoHeat CC for the years ended 31 December 2024 and 31 December 2025. Okay. Another thing that's very important is to see exactly what is the years that they require you to do the journals. Sometimes, and this is especially more in Learning Unit 3, but sometimes they can just ask you the start and the end journals. For instance, this started on, let's say, December 2024, then they want you to do that journals, and then December 2028, for instance. Okay, so make sure that you then only do those two, because that's what you will have time for. But also be careful if they ask you to do it for the full period. So let's say, in other words, from 2024 all the way up to 2028. Okay, so that's very important, because remember, your time is allocated to the amount of the marks that this question will have. So if they only ask you for, like in this case, 2 years, you will only have time to do 2 years. Then don't go and do, let's say, all 4 years that you might have or whatever, because then you're going to run out of time. Okay, and it's also important to just make sure that you do 2 years. Don't just assume that it's your current year and then do that year and carry on. Okay, then in terms of the transaction with Whistledown Limited, that's the next transaction, discuss how the transaction price must be allocated to the performance obligation and calculate the total revenue to be recognized for the year 31 December 2024. Again, this is very important. If they ask you discuss and calculate, make sure you do both. Okay. In test 1 of this year, where you had the true and false, and I don't know if your lecturers told you this, but if the answer were false, you only got the mark if you explained. Okay, because it said true or false, and if it's false, explain why, or something like that. So if you just wrote false, you didn't get any marks, even if it was correct. It was false with an explanation. Okay, so make sure if they ask you discuss and calculate, make sure you do both. Okay, so that they don't say, for instance, if there's no discussion, no marks. Okay, make sure that you do both. And then at 1.3, state what the impact would be on the amount of revenue recognized if the standalone selling price of the maintenance planning transaction 2 increased from 7,200 to 9,600. Okay, so back to 1.1, we have to do journal entries to account for the sale of the heating system for transaction 1. Okay, let's see what transaction 1 tells us. Okay, transaction 1 tells us that on 1 January 2024, Eco Heat CC entered into a contract with Danbury Limited, in terms of which Eco Heat CC must supply a heating system to Danbury Limited on the 31st of December 2025. Danbury Limited paid the transaction price of 120,000 Rand on the 1st of January 2024. Okay, so this is exactly now as my example that I've used earlier on. So what's happening is they entered into a contract. The one company need to pay, and the other company need to supply a heating system. Okay, the one company, Danbury, they paid the price on the 1st of January 2024. But Eco Heat CC didn't perform yet. Okay, because they tell us there they will only supply the heating system on the 31st of December 2025. Okay, so when this transaction started on the 1st of January 2024, it's bank and contract liability, because Eco Heat CC received the money, but they didn't do anything yet. Okay, so that journal will then look like this. So on the 1st of January 2024, when they entered this contract, sorry, I see my narration there is wrong. Recognize. Contract liability. Let's almost say on receipt of money. Sorry, I think I forgot to change that one. Okay, so we are recognizing a contract liability on receipt of money because we cannot recognize revenue because the obligation is not met. Okay, so we debit bank, we credit contract liability. Okay, so that's what happened on the 1st of January when we entered into this contract. Okay, now what's going to happen at the end of the 2024 year? Because remember, they ask us to do journals for 31 December 2024 and 31 December 2025. Okay, so now what's going to happen at the end of this year is that we will be charged with interest. Okay, because what happened is we've received money, but we didn't do anything yet. Our part of the obligation is not met yet. So we will then be charged interest. So at the end of the year, we need to then debit interest expense and credit contract liability. And you'll see if we go back to the question, they're just above transaction 1. They tell us that you can assume that the effect of financing is considered to be significant and a discount rate of 7% is applicable. So this 7% is what we will then use to charge interest. Okay, so now on the 31st of December, we take that 120,000, that's the contract liability amount, and we times that with 7%. And then you'll see your narration. We recognize finance cost for the year. Okay, just before we continue, any questions at this stage? Okay, nothing. Okay, then we can continue. Okay, so now on 31 December 2025, that is then also the date that they now do their obligation. Okay, so they actually deliver on their obligation. But before we can recognize revenue, another year have passed, meaning we need to charge, or we will be charged interest for another year. But now just remember, your contract liability has now increased from 120,000 to 128,400. Okay, this 8,400 interest was added to contract liability. So now if we charge interest, it's not interest on 120,000, it's interest on 128,400. Okay, I'm quickly going to repeat that again. So originally, when we recognized the liability, that liability was worth 120,000. But then at the end of that first year, we charged interest. Okay, we charged them, or we are being charged 7% interest. There's your 7%. So we are increasing the liability with 8,400. So now in the 2025 year, when we recognize the interest or calculate the interest, it's on 128,400. Okay, so that journal will look like this. So there you can see it's 120,000 plus the 8,400 and then times 7%. Okay, because we are being charged interest again, 7%. Okay, and now lastly, also on this date, the 31st of December, now we can recognize revenue. Because if we jump back to the question, they tell us there at transaction 1, they must supply the heating system on 31 December 2025. So we first charge them interest for the 2024 year and the 2025 year. And now we can recognize revenue because on the 31st of December 2025, that is when Eco Heat CC will then supply the heating system. Now, just also be careful. If we now recognize revenue, it's not only 120,000 that we recognize. It's the 120,000 plus the interest from 2024 plus the interest from 2025. Okay, so we have to add those interests together because we are increasing the contract liability the whole time. Okay, so when we then recognize revenue on the 31st of December, we debit contract liability. We credit revenue. And then we recognize revenue on transfer of goods. And that is then your original 120,000 plus the interest from 2024 plus the interest from 2025. Okay, any questions before we go to 1.2? Guys, there is one question. Should we indicate in the journals that it is recognized in profit and loss and statement of financial position? That's not compulsory for you, so no, you don't have to. Obviously, you can if you want to, but no, it's not compulsory. Okay, so there's another question. Who is paying the interest and why? Okay, so if we jump back to the question. Okay, so Echo Heat CC is the one that will be paying the interest. And the reason for that is because they've received the money. So Danbury Limited already paid them, but they didn't deliver yet. So because they will only then supply the heating system 2 years later. So from when Danbury paid the transaction price, Echo CC or Echo Heat CC will only supply 2 years later. They need to pay interest on that transaction. But it's, I almost want to say, technically, they're not really paying anything because at the end, they then recognize that part as revenue. So in a sense, they get all the money back, if you understand what I'm saying. So for 2024 and 2025, it's interest expense. But then also in 2025, when we recognize revenue, we then recognize that full amount as revenue. So they're technically not losing out any money. That's just if you enter in a contract and you're not immediately basically supplying what you need to, then there will be an interest part that you have to look at as well. Okay. Then there's another question. Should we not include the installation cost as well on the cost of the heating system? Zanda, I think, just quickly want to see. You are referring to this. So for this, we'll jump back to this in transaction 2. So in transaction 1, they just specifically tell us this was the price. So then we don't worry about all these information that they give us. Okay, so what we need to worry about for specifically transaction 1 is that they tell us they enter into this contract. They must supply a heating system. So probably in supplying this heating system, the installation and all of that is included already. And then they just tell us the transaction price for this is 120,000. So if they give us transaction price, that's for the full transaction. So including everything that should be in there already. Okay, any other questions before we look at transaction 2? Okay, then we can go to transaction 2. Okay, so in transaction 2, they tell us that on 1 March 2024, Whistledown Limited purchased a heating system, installation of the heating system, and a maintenance plan from EcoHeat CC for 130,000 Rand. On 1 April 2024, EcoHeat CC supplied the heating system to Whistledown Limited and performed the installation. The maintenance plan consists of 6 services of the heating system every 2 months on the first day of the month, commencing on 1 July 2024. Whistledown Limited paid the full transaction price to EcoHeat CC on the 1st of March 2024. Okay. So now, when they specifically tell you like this, they at the beginning, they purchase the heating system, the installation, and the maintenance plan, and they give you one price. Then you refer back to the question where they started the question, they give you the standalone prices of the goods supplied are as follows. And because it's all three these items that they give you the standalone prices, and in transaction 2 they specifically tell you they purchase all three for one amount, then we need to use the standalone price. Okay, so what we're going to do is I'm first going to discuss the calculation and then we'll go back to discussing. So we put the 3 separate and then we add the total. So if you take 120 plus the 15,000 plus the 7,200. Okay, so that is what it will cost if you purchase all 3 separately. But then they tell you in transaction 2 that the company purchased the 3 items together for 130,000 Rand. Meaning this standalone prices is limited to 130,000 Rand. So because if they purchase it sort of as a package, it's only costing them 130,000 Rand. You cannot recognize revenue of more than 130,000 Rand. Okay, so as soon as you see standalone price, there's a limit. Okay, so I'm going to jump back to the calculations first. So there you can see eco-friendly heating system. So this is the standalone price for the system. So it's 120 plus the 15 plus the 7,200. Okay, if you add the 3 together, you get 142,200. Okay, so that is the price standalone. Okay, so if you purchase each one separately. But because they tell us now that this company purchased all 3 and they only pay 130,000, meaning we cannot recognize revenue of 142,200 because that's not the money that we've received. We can only recognize a maximum of 130,000. So then there on the right-hand side, allocation of transaction price, you put 130,000. Okay, but now we need to recalculate then the amounts for each of these items. Because for eco-friendly heating system, we cannot recognize 120,000 Rand because then in the end, we're going to end up with a revenue of 142,200, which is not the case. We just said that this is limited to 130,000. Okay, so now we have to recalculate. So to do that, we first work out this eco-friendly heating system, the 120,000. What is the percentage that this 120,000 is of the total 142,200? So there in the middle, the ratio, oh, sorry, let me just remove that N, ratio. There you calculate the percentage. So you take the 120,000 divided by the total, which is 142,200, times 100, then you get the percentage, 84.39%. Then we do the same for the next one. So installation service, the 15,000 divided by the total, which is 142,200, times 100 will then give you 10.55%. And then lastly, the maintenance plan. So the 7,200 divided by the total, 142,200, times 100 will then give you 5.06. And please just bear in mind that we do take rounding into account with these ratios. So for instance, if you have 84% and then 11% and then 5%, that will be taken into account. Probably in the question, they will tell you what is the decimals that you need to use. We normally might use 2 decimals, but you won't be penalized if your rounding is not 100% the same as what we have or as what the memo will have. Okay, so just bear that in mind. Okay, so now we've calculated the percentage that the heating system is of the total. The same for installation services, the same for the maintenance plan. Now we can recalculate this on the total of 130%. So now for the eco-friendly heating system, we take the 130,000 times this 84.39%. So now we can see that the eco-friendly heating system is 109,707. Okay, so this is the maximum revenue we can then recognize on this eco-friendly heating system. Then on the installation service, we take also the total, the 130,000, times that with 10.55%. Then we get a total of 13,715. And then the last one, the maintenance plan, we take the 130,000, times that with 5.06%. And then we get 6,578. Okay, so now we have recalculated the revenue. Okay, so on the friendly heating system, we cannot recognize 120,000. The maximum we can recognize is 109,707. Same for installation service. We can't recognize 15,000 because then the total is too high. We can recognize a maximum of 13,715. And then on the maintenance plan, the same story. We cannot recognize 7,200. We can recognize a maximum of 6,578. Okay, so that's the calculation of the total revenue that can be recognized. But now we need to figure out what is the actual revenue that we can recognize. Okay, so this allocation of transaction price, that's the maximum revenue we can recognize. But remember now, we have a maintenance plan. And they tell us in the question, sorry, let me just get there. There's a maintenance plan. There they tell us the maintenance plan consists of 6 services of the heating system every 2 months on the first day of the month, and it's commencing on 1 July. Okay, so meaning that maintenance plan at the end of the year, we wouldn't have the 6 services yet. We're only going to have a portion of that. Okay, and our year end is still in December, because at the required part, they ask you to do this for the year 31 December 2024. Okay, so if they tell us that the services or the maintenance plan starting on the 1st of July, so we're going to have 1 service, 1st of July. Then August, we're going to skip. Then we have the 1st of September. October, we're going to skip. And then we have the 1st of November again. So in this current year that we are in, we will have 3 of the 6 services. So meaning for the maintenance plan, we cannot recognize the full 6,578 because we're only going to have 3 of the 6 services. Okay, the heating system that we can recognize in full because that is delivered. They also tell us that it was installed, so that installation we can also recognize in full. So the total revenue to recognize is the eco-friendly heating system. So that's the full 109,707 that we've calculated. The installation service is the full 13,715 because it was installed completely, so we can recognize that. But then on the maintenance plan, on that 6,578, we can only recognize 3 of the 6 services. Okay, so that total is for the 6 services, but we only had 3 in this current year. So then we can only recognize 3,289 Rand. So then your total revenue that you can recognize, so even though they've received 130,000 Rand, because that's what they tell us in the question, the company paid 130,000, they can only recognize in this current year 126,711. Okay, any questions on the calculations there? Let's quickly see. Does that mean we don't have to do allocation, transaction price workings? So I just need you to maybe explain that a little bit more. Does that mean we don't have to do allocation, transaction price workings? You always have to do. Oh, I think you refer then to transaction 1. Yeah. Okay. Yeah, so for transaction 1, because they didn't specify exactly what they purchased, then you don't have to, because they just tell you that's the transaction price, then that's the transaction price. But like in transaction 2, where they specify, this is the one that you are purchasing and this and that, then we have to do the allocation for the transaction price. Okay, then will we get the PowerPoint you are using after the masterclass? Yes, you'll definitely do. Then please show the explanation slide again. I'm quickly going to show, I'll do both. So I didn't discuss this yet. We'll get back to the discussion. So there's your allocation. Then I'll show the next one again. I think then we can take a break and then we'll look at the discussion from 1.2 and then we'll do 1.3 and then we'll continue. Okay, so if I were you, I would really make sure that I can do the standalone transaction price. That's one that they've actually been asking quite a lot. They really like to ask this. So maybe make my sure that you can do the standalone price. Okay, and then just the next slide. So 1.3 we didn't do yet. We'll get to that. So there's just again the total revenue to recognize. So there it's just important to see what of these obligations have been met already. So the heating system, that's met. It's been there, it's been delivered. It was installed, so the installation service was completely completed. But it's the maintenance plan where we got 3 of the services, but the other 3 we will then get in the next financial year. So maybe just on that note, if they now ask you, what is the total revenue recognized for the 2025 year? Okay, so this is for the 2024 year. But if they maybe ask you for the 2025 year as well, remember, then it's only the other 3 of the 6 from the maintenance plan. We're not going to recognize the heating system again because that's done. That was in this year. We're not going to recognize the installation services again. That's done. We will only recognize another 3,289. And then if you take the 126,711 from 2024 and you add 3,289 from 2025, then you will get to 130,000. So it's not that we are missing out on anything. We've received 130,000. We will recognize in this first year that we are in, recognized 126,711 because that's the obligations that we've made. And then in the next year, we'll add the 3,289. So then in total, we have recognized the full 130,000 that we've received. Okay. Any questions there? Okay, so then we can take a break. I see it's almost 9:25. So let's go till 25 to 10. So about a 12-minute break. Then we'll finish 1.2, do 1.3, and then we'll move into question 2. Okay, so just again, if you have any questions, you're more than welcome to post them there. But I will only after the break answer the questions. Okay, so that everyone can just be on the same page, that we don't get questions again that have been asked already. Okay, so if you have something to say or to ask, you're more than welcome to post that in the chat. And then after the break, we'll look at those questions as well. Okay, so you can take your break. We'll talk again in about 11 minutes. Okay, let's continue. Okay, so now we did 1.1. So in the previous session, we had a look at the journal entries. And then we had a look at the calculations for 1.2. Okay, so at 1.2, they also ask us, in terms of this transaction with Whistledown Limited, discuss how the transaction price must be allocated to the performance obligation and then calculate. Okay, so let's look at the discussion. Okay, so we already did the calculation, not the discussion yet. So at the discussion, you can have something like this, and we'll go through that now. Just remember, on your discussions, it's students' own words. Okay, so something like this, for instance, you can read through that, and then from what you understand, you give an answer. Okay, it doesn't have to be word by word like this. So don't go and study this off by heart. Read through that and get something that from what you've read, you can understand and then write down. Just also remember, when you get something like this in a test, after you've written your whole story, just quickly read through that again and make sure that what you are trying to say is actually making sense. Okay, because sometimes I know you are stressed in that test situation, but sometimes we get an answer that when we as a lecturer read through that, you don't have a cooking clue what the student was actually trying to tell you. Okay, so as long as we can understand what you are saying, you'll get your marks. Okay, but you can have something like this. At the inception of a contract with a customer, the entity allocates the transaction price to the performance obligation identified. Okay, so if you think about the calculations we did, that's exactly what we did. We took the transaction price, the 130,000, and we allocated that to the three obligations that we had. We had the system, we had the installation, and we had the maintenance plan. Okay, so think about your calculations, and from what you are doing there, just give it in words as well. Then the allocation of the transaction price depicts the amount of consideration to which the entity expects to be entitled in exchange for satisfying each performance obligation. Okay, so in other words, that's the money that they will receive for every obligation that they have to do or have to meet. The transaction price of 130,000 Rand will be allocated to the performance obligations based on the standalone selling price. Again, that's what we did in the calculation. We said this item on its own is costing this amount. Then the next one, then the next one. Then we had a total of 142,200. That's the standalone selling price. But then we allocated the 130,000 to each performance obligation. There are three performance obligations: the heating system, the installation service, and the maintenance contract. The total of the standalone selling price is 142,200. So if they only then paid 130,000, there's a discount of 12,200. And by allocating the discounted transaction price, the discount of 12,200 is allocated automatically to each of the three performance obligations in the same ratio as their relative standalone selling price. Okay, so what's also important, what I always try to do in a question like this, because a theory question is sometimes difficult for you as a student to really know what do they want. Okay, they ask me to discuss, but to what extent should I really discuss? So then I would sometimes think that the best way in accounting to answer a theory question is that if you think it, so if you think something, ink it. Okay, write it down. So probably you're going to sit and say, okay, if I purchase the three separately, it's 142,200, but now the transaction price is 130,000. Then probably as you do that, you're going to think, oh, yeah, there's a nice discount in there. If you think that, put it down. Okay, write it down, because that's something where your lecturer can give you a mark. Don't think something in your head and then just sort of ignore that. Okay, if you think that, ink that. Okay, put it down, write it down. Okay, so you'll see this looks bad if you look at all of this, but it's not. That's exactly what we did in the calculations. Okay, so a discussion is not that bad. Okay, I know if you see the words discuss or explain or something like that, then you want to run away because that's theory. Okay, but in a sense, don't just run away. Okay, think this through. They tell you, discuss how you will do this and do the calculation. The calculations we did. So now you just have to put your calculation in words. And that's exactly what we did there. Okay, any questions on that 1.2 discussion part? Okay, then at 1.3, they ask us to state what the impact would be on the amount of revenue recognized in the standalone selling price of the maintenance plan in transaction 2 increases from 7,200 to 9,600 per annum effective from 1 January 2025. Okay, what I've also realized is that some of you don't properly read the question. You just see something and then you run away with that. Okay, because if I just tell you what is the impact on the revenue recognized if the maintenance plan is increasing from 7,200 to 9,600, stop. If you stopped there, you're going to run to your calculations and then basically redo your maintenance plan. So then you will change this to 9,600. So your total is going to change here. The 130 will stay the same. Then you recalculate everything. Okay. And then you're going to get 0. The reason for that is, if we go back to 1.3, they ask us if this increase then take effect from 1 January 2025. Okay. In 1.2, we calculated the revenue up to 31 December 2024. So to this revenue that we've calculated in 1.2, there's going to be no change. Okay, so please, when you do your required part, read properly. Make sure you read everything. Don't just read, oh shucks, this maintenance is going to increase from 7,200 to 9,600, and then you run away with that. That's not the question. The question asks you only if this is effective from the 1st of January 2025. And then if you read the date with everything, then nothing is going to change. Because it's not in the 2024 year. It will change for 2025, but not in this current year. Okay, so then you can have something like, there would be no impact on the amount of revenue recognized because the transaction price is not reallocated or changed to reflect changes in the standalone selling price after contract inception. Okay, so don't go and run away with something because you didn't read your question properly. Okay, Any questions on question 1 or then learning unit 2? Okay, so just something else that I just also want to add to learning unit 2. So just also remember in learning unit 2, they can ask you the theory, like a proper 30 marks theory question. Okay, because remember in learning unit 2, we have the 5 steps that we have to work with. So they can ask you, so give you a scenario like they did in this test, but then ask you to explain the revenue that will be recognized using the 5-step method. So then you will have to say, what is step 1? Give a bit of an explanation. And then if there is calculations, you're going to have to do that as well. So for learning unit 2, they like to either ask more like maybe a bit of journals and calculations like we had in this test, or they can ask you to give the 5 steps, properly explain or discuss them, and then do a little bit of calculations in there if that's necessary. Okay, so please don't forget about that. You have to still study your theory. Okay, same as what we had in second year accounting, where they can give you the 5 steps and not give you the 5 steps, you have to also name the 5 steps, but then give the proper theory behind all of that. Okay, so just please bear that in mind as well. Don't go in learning unit 2 and just focus on calculations. Okay, so it's probably going to be either or, but just please keep that in mind. Okay, your theory for learning unit 2 is still very, very, very much important. Okay, any other questions maybe on learning unit 2? Okay, there is a question, will there be deferred tax in test 2 next week? I can't definitely say no, because learning unit 1 is still part of the learning the learning units that you have to study for the test, but probably not really, because they will be focusing on learning unit 2 and 3. So if there's something from learning unit 1, it's probably going to be a small, like just a quick 5-mark question or something like that. The focus will definitely not be learning unit 1. Yeah, unfortunately, if it's something that is in your textbook, you can be tested on that, yes. So right of return, yes, they can. Yeah, so that's maybe something good for me just to mention to you. Remember, we as lecturers, we try to cover as much as possible in a learning unit with the time we have with you. But if it's in the textbook, it can be asked, okay, unless it's specifically excluded in your module outline. So you have to just take that in mind as well. Like for instance, if they specifically tell you to exclude impairment, for instance, then please exclude that. Okay, don't study that. It's not necessary. But anything else that you have to study, if it's in your textbook, it can be asked. Okay, even though maybe the lecturer didn't do that in class, maybe they weren't time, or maybe the lecturer thought it's probably not as important because it wasn't asked in the last 5 years or whatever. But please, if it's in the textbook, it can be asked. Okay, so please bear that in mind. Okay, if there is nothing else on this learning unit, then we can continue to learning unit 3. Okay, so you'll see then in this test, question 2 was then also 30 marks, and that was learning unit 3. So just again, remember for this learning unit, please make sure you know how to use your financial calculator. Okay, make sure your batteries are fine, make sure you have your calculator. because that's probably going to save you a lot of time. Okay, so they tell you there you have recently been appointed as the accountant of Nexus Pty Limited. The following information regarding the financial instruments of the entity is available for the year ended 29 February 2024. Okay, before we look at this, I'm going to go to the required part again. So we have there number 1, number 2. Then at the required part 2.1, they ask you to prepare the journal entries to account for the bonds in the accounting records of Nexus Pty Limited for the year ended 29 Feb 2024. Journal narrations are not required. Round all calculated amounts to the nearest rand. Okay, again, if they ask journals, make very sure about the date. Okay, so we only have to do it for the year end 29 Feb 2024. Okay, then at 2.2, assuming that the financial asset is classified at amortized cost, calculate the gross carrying amount on the 29th of Feb 2024, and then they give you a hint. And if they give you a hint, please look at that hint. Okay, they are actually guiding you where you should go. Begin by calculating the effective interest rate, taking all information into account, and round to 3 decimal places. Okay, again, as I mentioned before, that is important to round to 3 decimal places, but rounding will be considered when we mark. Okay, so just bear that in mind. Then at 2.3, they ask you to calculate the liability component and the equity component of the debentures at the time of issue on 1 March 2023. So that's now 0.2. And then 2.4, do the journal entries to account for the debentures in the accounting records of Nexus Pty Limited for the year ended 29 Feb 2024. And that's then also 0.2. Journal narrations are not required, and round all calculated amounts to the nearest rand. Okay, so again, if they tell you that narrations are not required, please don't do them. Okay, it's going to waste your time, but please make sure if it is required that you actually do them. Okay, in a lot of tests that I mark, they sometimes ask for journal narrations are required, and then students, maybe they do the first journals one, and then from there, they just forget that. Okay, make sure that's easy marks. Okay, we want you to pass. So if they tell you a narration are required, make sure that you do your narration. Okay, so for 0.1, we have to do the journal entries and we have to calculate the gross carrying amount. Okay, so let's see what they tell us at 0.1. So they tell us there, on the 1st of March 2023, Nexus Pty Limited acquired an interest in 10% government bonds with a par value of 2,500,000 at the fair value of 2,300,000. Okay, so that's the first issue we have. We have two values. We have a par value, we have a fair value. Okay, it's important for learning unit 3 to always use the fair value. Okay, so this is the first thing where they can confuse you, which one to use. Okay, so the value of this is 2,300,000. Then they tell us transaction costs amounting to 5,000 Rand were incurred. The government bonds mature at a premium of 5% on the 29th of Feb 2028, and interest is payable annually in arrears on 28 Feb. The fair value of the 10% government bonds amounted to 2,370,000 on the 29th of Feb 2024, and Nexus Pty Limited designated the investment as a financial asset at fair value through profit or loss. Okay, so this is very important. This last bit is how they designate this investment. Okay, because remember, this will tell you whether transaction costs are part of the cost or not. Okay, so because it's a financial asset at fair value through profit or loss, transaction costs is separate. It's seen as an expense, so it's a separate line item in your journal. Okay, so first of all, we have to do journals for the 2024 year. Okay, so the first journal we're going to do will be on the 1st of March, okay, when they acquired the interest. Then remember, the important part is the fair value. So this will be a financial asset. The fair value is 2.3 million. Then transaction costs will be separate, 5,000 Rand. And then we'll credit bank. Okay, they don't really tell you whether it was paid or not, but you'll probably always then assume that it is paid. So then we credit bank. Okay, so let's quickly go there. So on the 1st of March 2023, that's when they acquired the interest. We debit financial asset at fair value through profit or loss. So that's the fair value of 2.3 million. Then we said, because this is a financial asset at fair value through profit and loss, transaction cost is seen as an expense. So it's a separate line item, 5,000 Rand. And then we are paying that, so we credit bank 2,305,000. Okay, so that's at the beginning. So there we recognize the financial asset. Now we have to also do this for the year end. Okay, so now on this financial asset, so because it's an asset for us, we're going to have interest income. And now we go back to the question to figure out where do we get the percentage to calculate the interest. Okay, and they tell us there at the beginning, it's interest in a 10% government bond. Okay, so we don't worry about the mature at a premium of 5%. If we want to calculate interest, it's on the 10% because that's the percentage of the bond. So now we use the 2.5 million to calculate the interest. Okay, so you use the par value of 2,500,000 times 10%, and then we get the interest income amount. Okay, so we debit bank to 2.5 million times 10%, and we credit interest income. Okay, then also on that date, they tell you there in the question, the fair value of the 10% government bonds amounted to 2,370,000 on the 29th of Feb 2024. Okay, so originally when they acquired the interest, it was 2.3 million. And now the fair value changed to 2,370,000. So meaning we have a fair value adjustment. Okay, so you can say fair value gain or fair value loss. You can do that. I always say rather put the words fair value adjustment because it sort of covers you. Whether you have a gain or a loss, you can't then basically lose marks for the wording. Okay, unless your debit and credit is now obviously also wrong. But if you just say fair value adjustment, it's a bit of a safer term to use. But you can say if there's a gain, you can say fair value gain. If there's a loss, fair value loss. Okay, so the fair value is increasing. So it's moving from 2.3 million to 2.37 million. So then you will debit your financial asset because the value is increasing, and then credit fair value adjustment. Oh, sorry, it's this last one. Okay, and it's the difference between the two that you will then do your journal on. Okay, any questions up to this point? Okay, there is a question. What if Nexus designated the investment as a financial asset at fair value, other comprehensive income? Okay, so what will happen then if we go to that journal? So if we then go to this journal, so it's only if it's through profit or loss where your transaction cost is a separate line item on its own. So if this were through other comprehensive income, then this transaction cost will fall away there, that line item, and then your financial asset there at the top will be 2,305,000. Then your income, your interest, that will still be calculated on the 2.5 million, but then your fair value adjustment, your value there will be 2,370,000, but then the original value will be 2 million and then 305,000. Okay, so your fair value adjustment is going to change, and then also that first journal. So in the first journal, you won't have transaction costs there separately. This 5,000 will be added to your financial asset at fair value. Okay, the same if it was a financial asset at fair value through amortized cost. Then this transaction cost will also not be there. It will be added into your financial asset cost price. Okay, so there's a question. Do you think the majority of test 2 will be from learning unit 2 and 3? Yes, definitely. Okay, they will definitely focus on learning unit 2 and 3. Okay, any other questions? Okay, so we do not consider the transaction, the transaction cost at initial recognition when dealing with OCI scenario. You do, but then your transaction cost is part of your cost of your asset. Okay, so it won't be a transaction cost as an expense, meaning separate line item. That 5,000 Rand will then be added to your asset. Okay, then there's another question, Zander. Isn't amortized cost through fair value less transaction cost and not adding it? Yes, it is. Sorry. Yeah. So at your amortized cost, you will minus the 5,000. Then why is interest calculated at the 2.5 million? Because that 2.5 million, that is actually the value that it is in that company. So for these type of things, the bonds and things, there will probably always be two amounts. The one is the value in the company. In this scenario, it's the 2.5 million. The other one is the fair value amount. So your bond if you have a look at what the actual value is, it will always be at fair value. But then the interest that you will receive is on what the company will give you. And for the company, the value is 2.5 million. Okay, I hope that answers your question. Then another one, am I correct in saying that when measured through OCI, we use mark-to-market reserve instead of revaluation surplus? Yes, mostly it is, but then the question will also actually tell you that. So if it's measured through other comprehensive income, 99% of the cases you will use the mark-to-market reserve and not revaluation surplus. Yes, you are correct. Okay. Any other questions before we move on? Okay. Then we can look at question 2.2. So they had 2.2. They tell us, assuming that the financial asset is classified at amortized cost, calculate the gross carrying amount on the 29th of Feb 2024. And this is then where they give you the hint. Begin by calculating the effective interest rate, taking all information into account. Okay. So let's go back to the information given. Okay, so if we now need to calculate the interest, and they tell us there that it's at amortized cost. Okay, so now your present value, because they give you that 2.3 million on the 1st of March. Okay, so that is then your fair value at the beginning. So that's your present value is 2.3 million. Sorry, I'm just now thinking about your question on amortized cost. Should we not minus the transaction cost? But it isn't. It's still included in your cost. So Zander, on that, if it's amortized cost through fair value, less transaction cost, you are still adding that. So for both other comprehensive income and amortized cost, you are adding the transaction cost. It's only then for profit and loss where it's separate. Okay, so you are still adding that. Okay. Okay, so then back to this. So to calculate your interest, so we take the 2.3 million plus the 5,000 as your present value. Yeah, I will show you that slide just now. Then your years, so they tell you 1 March 2023 and it's ending 29 Feb 2028. Okay, so February 2024 is year 1. February 2025 is year 2. February 2026 is year 3. February 2027 is year 4. February 2028 is year 5. Okay, so we have N of 5. Then your payment. So again, your payment, it's the 2.5 million. So that's the value for the company times 10%. So that's 250,000. And then your future value is also then the 2.5, because that's what it will be worth in the company. But then they tell you that it will mature at a premium of 5%. So you take the 2.5, then plus 2.5 million times 5%. Okay, and then you calculate interest. So by using your financial calculator, you then calculate interest. Okay, so your present value is the fair value plus the transaction cost. N is 5. Payment is the company's value times the 10%. And then your future value, they tell you you're going to have a premium of 5%. So in other words, it will basically grow by 5%. And then you can calculate interest. Okay, so then you have your interest percentage, and now you can then get your balance. Okay, so I hope all of you know how to do the amortization schedule. But if you've now calculated this on your calculator and you're sitting there with your screen and it's showing 12.989, if you then press the AMRT button, okay, it stands for amortization. So it's on the sharp calculator. I think it's in the last row there at the start where there's all that lots of little buttons. So I think in the last row, the left button, it says AMRT. So if you then press that and you go with your arrows up and down, you'll get the interest and you'll get the balance. Okay, so on my next slide, so the investment, this is the present value that you started with. Your interest year one, this 299396 should be on your calculator. It says interest. Then your installment is the same as your payment in your calculation. And then this balance should also be on your calculator. Okay, so if you just go down with the arrow, so after you've calculated the interest on the previous slide, you press the AMRT button, then you'll see your interest will display on the calculator as well as the balance. Okay, but just please still put it like this that you can get all the marks that you need. Sorry, just give me 1 second. I'll be back just now. Sorry, there was just the noise that I wanted to cancel out. Okay, so even though the 299396 and then the balance will display on your calculator, just please put it like this, that we can just know that, okay, this is how you got to the balance. Okay, any questions on 2.2? Okay, how do we know that we must calculate interest? They actually tell you that in the question. They tell you, or let's just jump to the question. There's a hint, and then it tells you by calculating the effective interest rate. If they didn't give you this hint, then if you look at point 1, remember, for you to be able to use the interest percentage, in your calculation, they have to give you the market-related interest rate. And in this number one, there is no market-related interest rate. They give you a 10% government bond, but that's to calculate the payment. That's not the market-related interest rate. So then that will then also tell you that you have to calculate your interest rate that is basically then market-related. Okay, so you're saying you're using the HP calculator. The answer is a few rands off. Is that okay? Yes, that's perfectly fine. Probably also because you'll see on my slide there, my interest is rounded to 3 decimals, but most of the calculators will round it to 4 decimals. And then obviously you're not going to change that. You're going to leave it as is and press the AM or T button. So then obviously because of rounding, it will be out by a few rands. So that's perfectly fine. Okay, I will go back to that carrying amount answer now. So the market-related interest rate is the interest used to find the present value, for example, right? I'm not sure I'm understanding your question 100%, but what I think is what you mean is like if they didn't give you the present value, but they gave you the market-related interest rate, then you can use that to get your present value. So yes, that's correct. But in this case, so they normally they will give you either the present value or the future value with the market rate. Then you'll calculate either the present value or the future value. But in this case, they gave you the present value, they gave you the future value, but then they didn't give you the market-related interest rate. So then, yes, you had to calculate that. I hope that answers your question. Okay, I will quickly go back to this calculation. Okay, any other questions on 2.2? Okay, so I think let's stop there for another break. Let's now go till 10:30. It's again about more or less 12, 11 minutes. So at 10:30, we'll then finish this question. And then if you have any questions and answers, we can do that question and answer session then after that. So maybe in this time, think about questions that you might have on either of the learning units, not specifically to this test necessarily, but just sort of in general, because we will then, I think, have a bit of time to look at that as well. Okay, so then at 10:30, we will continue. Okay, let's continue. Okay, so just before the break, we were busy with question 2, which is then learning unit 3. So we already did then 2.1 and 2.2, which was from point 1. And now at point 2, they ask us to calculate the liability component and equity component of the debenture, and then also to do the journal entries to account for the debenture in the accounting records for the year ended 29 Feb 2024. Okay, so let's first look at point 2. So at point 2, they tell us that on 1 March 2023, Nexus Pty Limited issued 500 convertible debentures. The debentures have a 4-year term and were issued at par, that is equal to fair value, with a face value of 4,000 Rand per debenture. Interest is payable annually in arrears on the 28th of Feb at a nominal interest rate of 8% per annum. Each debenture is convertible on maturity date into 100 ordinary shares at the option of the holder. Okay, that's very important, that at the option of the holder. And then the debentures is not converted into ordinary shares, will be redeemed in cash at face value. The prevailing market interest rate for similar debt without conversion option amounted to 10% per annum when the convertible debentures were issued. Okay, so in this scenario, we then have to calculate the present value. But what is very important, if we have a debenture and it's convertible, we have to first see, is it automatically or compulsory convertible? Because then your future value will be 0. Because if all debentures are converted, then there's nothing left. But if they tell you, like they do there, it's convertible at the option of the holder, then you will have a future value. Because then it might be that not everything is converted. Okay, so I'm going to quickly repeat that. So if you have a convertible debenture, there's 2 options it can be convertible. It can be compulsory or automatically. That's the first one. And if that's the case, so if they tell you each debenture is automatically convertible, then your future value in your calculation will be 0. Because then there's nothing left. Everything is converted. Or then if they tell you, like they do here, it's convertible at the option of the holder, then you will have a future value. Okay, and that future value will be the amount of debentures you have. Like in this case, they issued 500 debentures. And you times that with the value. So in this case, 4,000. Okay, so in this case, it's at the option of the holder. So you will have a future value. So your future value will be the 500 debentures times 4,000 Rand per debenture. Okay, then your payment. And for your payment, you will use your nominal interest rate, because remember, your market interest rate is your interest in your calculation. So then for your payment, you will also take 500 times the 4,000 times 8%. I'm going to show you that slide just now. Then they tell you it's a 4-year term, so N is 4. There, right at the bottom, they give you the prevailing market interest rate. So that's your interest rate you're going to use, the 10. And then you can calculate your present value. Oh, sorry, other way. Okay, so there's your calculation for 2.3. So we will have a future value because it's converted at the option of the holder. So future value is 2 million. payment is that 2 million times 8%, which is your nominal interest rate. In the question, they tell you the term is 4 years. They give you the market interest rate as 10%. And then we can calculate the present value. Okay, then that present value calculated, that will always be your liability component. Okay, always. If you calculate that present value, that's the liability component. And then at 2.3, they've asked you to calculate the liability component and the equity component. Okay, so you calculate the liability component by calculating your present value. And then to get your equity component, it's your future value, the 2 million, minus the present value that we just calculated. And then you get an equity component of 126,795. Okay. Any questions on 2.3? Okay. Then 2.4, they ask us to do the journal entries to account for the debentures in the accounting records of Nexus Pty Limited for the year ended 29 Feb 2024. Journal narrations are not required. Round all calculated amounts to the nearest rand. Okay, now it's just important to see that it's the journals for the year. It's not only on the 1st of March when they actually they tell you they issued the debentures. So it's not just when it was issued, it's for the full year. On the 1st of March, when it was issued, we debit bank and then we credit, sorry, I want to go to the calculation there. Then we credit the liability component that we've just calculated, as well as the equity component that we've just calculated. Okay, so that's on the 1st of March. So that's when they issued the debentures. So we debit bank. We credit the financial liability and we credit the equity component. Okay, and then on the last day of that year, we will have to calculate interest. Okay, so it's going to be an interest expense because it's interest on that financial liability. And then we credit bank, and the bank that we credit will be the payment of 160,000. Okay, so this you can also get actually on your calculator. So if you fill in this, what we had in 2.3, and you get your present value, the 1,873,205, and you press the AMRT button, you will actually also get your interest amount. So if you go up and down with the arrows, you're going to get the interest amount. Okay, let's go to that journal. So your interest will be 187,321. This 27,321 is also on your calculator. All this can just be your balancing figure, because the credit of 160,000, that's your payment. Okay, so you have your interest, you have your payment. So then the difference between the two will then be your financial liability. Okay, any questions on 2.4? Okay, no questions. Okay, I know this is now actually very early. Maybe it's good for you, then you can still go and study financial management for today. But this is all that I have from my side. So I am still going to be here. We have another, about 40 minutes. So I will be still in the session. So please, if you have any questions, whether it's relating to this test that we did, or whether it's relating to any of the learning units, please, you're welcome to ask. Okay, it's a pleasure. I hope it's helping. Okay, I will go back to the last slide. Oh, sorry, that one. Okay, so those of you that are going to leave the session now, good luck with your tests. Good luck with all the studying. The end is near. Yeah, June is almost here. Then we have exams, and then we are done, guys. And then you've got a nice break, and then second semester is coming. Okay, so I hope it will really go well. We all want you to pass. We also want you to get your degree. So study hard, and then you're done with accounting. Okay, so as I've mentioned, I will still be here. Yeah, the end is near. So the end for this semester is very close. But yeah, we're in May already. So yeah, year end is also not that far. I mean, if we think your exam is probably going to be the beginning of November. So yeah, it's close. It's really close. Before we see, then you are done getting your degree next year. So yeah. Okay, I will also show you the calculation for 2.4 now. So yeah, so if there are anyone that wants to leave, please, you're more than welcome. We are done with what I wanted to do. But yeah, if there is more questions, then please feel free to ask. Okay, so there's your for yeah. So this is the calculations for 2.4 were already done in 2.3. Okay, so there's your calculations just again. Okay, so I'm just going to also mute my mic. But yeah, if there is any questions, please ask, and then I'll talk to you again. But yeah, good luck, and good luck with all the tests as well coming up. You must enjoy the rest of your day. So yes, for my students, the slides will be uploaded on Arc. For all the other students, the slides will be shared with your lecturers now. So you should have that probably a little bit later today. And then the recording will be uploaded on the YouTube channel. Okay, same as what we had with test 1. So the recording will be uploaded there. And then there's another question for the last journal. Do you debit or credit the balancing figure? I'm quickly going to share my screen again. Okay, so for that last journal, so for this specific scenario, you are crediting the balancing figure. But if this was now a scenario where the debentures are convertible automatically, then your future value will be 0. And then you'll see your interest will be less than your payment. So then the balancing figure will be a debit. Okay, so it's not always going to be the balancing figure is credited. So just make sure of that. So in this specific scenario, if you have a future value, then yes, your balancing figure is a credit. But if you had a future value of 0, because everything will be converted, then your balancing figure is probably going to be a debit. Okay, so just be careful of that. Okay. Okay, so how would we tackle point 2 if the debentures were automatically convertible? Okay, so then your future value will be 0. Okay, so instead of having the 2 million there that we have now, you will have a 0. So then obviously your present value will be different. Okay, so your journal, your first journal on the 1st of March, that's going to be exactly the same. Obviously the amounts will change because your liability will now be a different amount, but the debits and credit will still be the same. And then on your second journal, your interest will still be a debit, but obviously at a different amount. Your bank will still be credited the 160,000. And then your balancing figure will then probably be a debit. So you're going to debit your financial liability instead of crediting it. Okay, so but the important thing is if it's automatically convertible, your future value will always be 0. Okay, so either automatically or compulsory convertible, your future value is 0. Okay, if there's nothing else, I think we can then end the session. So thank you everyone for joining. Good luck with your studies. And then we'll probably speak again before the exams.